New housing starts are starting to pick up. They actually beat expectations. PPI, producer prices are lower. CPI is lower. Disinflation in Europe, the inflation war is pretty much over. GDP in Europe is at zero, flirting with recession. We're going into an election cycle. If GDP is low, if inflation is done, now you can start stimulating, boosting the economy. 65% of the funds, fiscal government spending is still waiting to be unlocked. The most leading economic indicators are going to be the manufacturing cycle for Europe in the euro area. They're in a recovery phase. If you go back to 2012, after the European debt crisis, the PMI is the most leading economic momentum indicator. It bottomed out and it started rising. I think we're in the recovery phase for Europe, which signals a global recovery going forward. Corporate debt. This is going to be a lot of people's issue. Well, corporate debt is so high. The amount of corporate debt has to be refinanced over the next couple of years. Stocks are going to really struggle. The corporations have to refi, right? What did we just get from the Fed? They will be cutting along the way to 2%. They're not waiting for 2%. They'll be cutting on the way down. 3.5% in 2025 is what they're looking at. So if rates are coming down to 3.5 for corporations, what does that tell you? That they can now refi back at normal levels. There is no massive collapse in corporate debt because going into 2025, those rates are coming down. Therefore, there's your soft landing. And if we look at commercial real estate tightening standards, they're starting to ease now. The tightening cycle is done. It peaked back in March of 2023 when the banking crisis actually hit us. Let's look at employment. Payrolls, they are falling, right? But they're not going negative yet. You're getting a slowdown. Unemployment still at historic lows, under 4%. The Fed is expecting 4.1% unemployment in 2024. Jobless claims, the most leading indicator for the employment market. Jobless claims are going nowhere. That is a signal that people have jobs or they're working or they are finding a job. If they get fired, they get laid off. There's always another job somewhere. The gig economy, right? Uber, Lyft, DoorDash, Grubhub, YouTube, content creation, OnlyFans. There's all these gig economy jobs. Now, S&P earnings, focus on the dark blue. The first bar is Q3. So Q4 is set to slow. Earnings are set to come down, but you get the rebound in the first to second half of Q1 for profit margins when it comes to S&P 500. And from there, margins or profit or revenue continues to climb. Now, historic rates. A lot of people say, well, rates are just too high. Stocks can't grow. I think we're looking at something akin to 1994 to 98, which was the technology boom. This was after the savings and loan crisis in 1991, and we started to recover. And I think we're looking a lot like this. So the reason I put this up here is because Fed rates were above 5%. Bond rates were above 5%, which are interest rates for the market, but the NASDAQ still moved 275%. Now, I'm not saying we get a 275% upside move from here because the NASDAQ is much bigger than it was in 95, but it can still move because technology solves problems and technology is transformative, right? Now, leverage. This is leverage versus the stock market, okay? So in the purple is stocks, that is S&P 500, SPX, and in blue, we saw the largest drawdown, by the way, in margin debt history. This is fund managers, retail, whatever you want to call it, leveraging up on margin to get leveraged into stocks, whether it's trading, investing, whatever it is. This was the largest drawdown in debt. And now we're just starting to see that leverage come back into the system. So we still have a long way to go. There's still a lot of cash on the sideline to come back into markets to chase premium stocks, to chase corporate debt or bonds, whatever it is. So that leverage is at low levels, which tells you that we're under positioned. The market is under positioned at the moment, even though we're still moving higher. Momentum indicators. The only central bank who has not really stepped up their stimulus is the EU because they've had the higher inflation rate. When your inflation rate is low, that opens the door for more stimulus, right? And so we've seen that fiscal stimulus, like we talked about earlier, monetary stimulus coming from the RRP, which is shadow liquidity for the Fed. And now we're looking at the EU. That's the last shoe to really pick up. And once it does pick up, well, I mean, you're getting a global reacceleration. As you see, the manufacturing cycle in the EU is already bottoming out. So this is the rise underneath the hood. It's a little more deeper macro. You just see headlines, delinquencies are at all-time highs, blah, blah, blah. But guess what? When it comes to the ratio between mortgage debt and income is actually very low. So people will keep spending. And when you add it all together, global liquidity is still picking up. The global liquidity cycle with the ISM or new orders is your trigger that we're moving higher. Think for yourself. You have your own opinions, whatever it is. But this is the data that gives us the soft landing for 2024. And it kind of shows us that we can rise. Now, if there's geopolitical risk, obviously, that's going to be different. If we have geopolitical risks start to step up, there could be a black swan event. So this is excluding any type of black swan event.